Assalamualaikum and greetings to our lecturer, Dr. Zahiruddin. Today our group will present about the implication of behavioral finance towards the derivative segment. Okay, before we start our presentation, let me introduce our group member first. Our group member consists of Nur Fahani binti Amshur, Loy Tong Chin, Muhammad Izamuddin, Nur Shohada binti Suhadi, and Goh Ek Leng.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Izamuddin. So I would like to introduce a little bit about our article with the title The Implication of Behavior Finance toward Derivative Segment. So first of all, what is behavior finance? Behavior finance is a field of study that examines how investors affect financial market. Behavior finance challenges traditional finance theory by recognizing that investors are not always rational and can be influenced by psychological bias. Behavior finance also particularly important in the derivative market, where contracts derive their value from underlying assets like stock, bond, and commodities. Next, we look in the view of derivative market. So, the derivative market is highly sensitive to investor sentiment and psychological bias, which can lead to market inefficiencies. Behavior bias such as herding, overconfidence, confirmation, anchoring, loss aversion, availability, and regret aversion can cause investors to make irrational decisions, leading to price distortion and mispricing in the derivative market.
My name is Lei Zhongjun. My meeting number is 279178. Now we will continue the presentation with the part of the main issue. The main issue for this research is to determine how the investors' behavioral bias can affect their decision making while invest in derivative markets. The research shows that the different behavioral bias can lead the investors to make different decisions for their investment in derivative markets. The research also states out that the training and education level which received by investor also is a crucial issue that can affect their behavioral bias. That's all for me. I will pass to the next presenter. Thank you.
Now we move to the discussion on the impact of behavioral bias. The first one is market inefficiency. Traditional financial theory often overlook the complexity of human behavior in the financial environment, focusing on market efficiency and rationality. Conventional financial model assume asset prices accurately reflect all information. However, behavioral finance investor cognitive bias such as herding behavior and overconfidence can cause market inefficiency affecting derivative contract pricing. This bias can lead to overstated or understated derivative instrument prices, allowing wise traders to profit from deviation from rational pricing. Next is risk management. Cognitive bias including herding behavior, loss aversion, and overconfidence can cause market players to take excessive risk or adopt risk-averse technique. This bias can lead to risk-averse strategies where market participants are unsure to take on positions that might result in losses, even if the potential gains are substantial. Risk-averse behavior in derivative market can affect market liquidity, pricing, and hedging, necessitating understanding for effective risk management and the development of better risk model. And the third point is impact on how investors behave and trade. Trading methods and investment decisions that are not optimal might result from bias like self-attribution and recency bias. Recency bias can lead to market bubble and herd mentality, while self-attribution bias can lead to excessive risk-taking due to externalizing losses and appointing successful transaction to one's ability.
Hi everyone, my name is Goh Ek Leng. My number is 291526. I will gonna present about the discussion 2. The point 1 is behavioral finance will give impact on the market dynamics. The cognitive biases can lead to the market inefficiency, causing the overreaction and the underreaction to the information and consequently deviation from the rational pricing. Which is the second point is behavioral finance will give reflection in the current investment trend. Behavioral finance, alike with the Trends like the rise of the retail trading and the social media influence, evident in this stock of the meme stocks, showcasing how biases contribute to the notable pricing volatility. The third point is challenges for the industry and the regulatory measures. As retail participation grows, addressing behavioral biases in a derivative market is become crucial. Education, training, increased transparency, and the regulatory action are the essential to mitigate the potential negative effects on the derivative tradings. So for the discussion 1 and the discussion 2 also is discuss about the behavioral finance in a derivative market. But the discussion 1, which presented by my group member, is about the specific implications such as market inefficiencies and their manifestation in a derivative market. And the discussion 2, which that I present, is provide a comprehensive overview of the role of the behavioral finance in guiding the investor within the derivative market. That's all my part. Thank you.
Okay, next I will present about the recommendation. First is strategic to mitigate behavioral biases. We would like to recommend of behavioral training programs for traders. By implementing specialized training program aimed at identifying and addressing the behavioral biases among traders. Incorporate practice method to enhance the awareness and control over biases in decision-making process. Next is by utilizing of advancement analytics. This can be done by making leverage advanced analytics to identify and mitigate the biases effectively. Next, moving on to our second recommendation, which is regulatory measures and institutional responses. We also come with a recommendation by study the institutional frameworks and regulation. This is to investigate how financial institutions and regulatory bodies worldwide integrate behavioral finance concept into their guidelines and policies. Next, by evaluate effectiveness and consequences. This can assess the impact and effectiveness of these measures in countering behavioral biases in the derivative trading. Last but not least, the third recommendation from us is future implication and emerging research areas. Anticipate a consequences of technology advancement. By anticipate a technology advancement, we can explore the potential impact of new technologies on behavioral biases in derivative market. Next, forecasting the impact on derivative trading. This can utilize the insight from technological advancement and changing trends to forecast their effects on derivative trading.
Now we move to the conclusion part. So here there are several points that I want to highlight based on our article. First, behavior bias impact derivative market dynamics and leading to inefficiencies. Second, herding, overconfidence, and loss aversion are common bias influencing derivative trading. Third, mitigating behavior bias is crucial for market stability. Fourth, behavior training, advanced analytic, and algorithmic trading can help to address bias. Number 5, regulatory measures are essential for effective governance of behavior bias. Number 6, emerging research area and global perspective are important for understanding behavior influences. Number 7, derivative market requires sophisticated understanding and proactive approaches to manage the bias. And lastly, continuous research, education, and adaptive measures are essential for resilience and efficiency.